Hello, welcome back. A subscriber of the channel asked to take a look at SFT Technologies. In case you are not aware of the company, it is actually, as you can see here, an end-to-end auto e-commerce platform for buying and selling of used cars. And they are situated in San Francisco, California. Now, the important thing to notice here, this is actually sitting in on the consumer discretionary sector. And what is that? So, consumer non-discretionary products are the products that actually people need to survive, like food or apparel, for example. However, are not something that we need to survive. They're an important thing in our lives, but it's mostly a luxurious item. And this means that if there is a downturn in the economy or a recession, these kinds of companies tend to not do very well. Plus, if interest rates rise and you get higher inflation, and then interest rates rise, which is a consequence of higher inflation, as it's happening right now, you could potentially have higher cost of borrowing money. And so, if you want to be borrowing money in order to buy a car, then it may be tougher for you because you're going to have to pay a higher interest rate. And so, bear those things in mind when you're taking a look at companies of that sort. Now, Shift Technologies here, you will see that it is a company that used to be close to $15 and right now it's sitting at 1.7, down a lot. You can see here it's like 82% down. It's a massive drop over here. But let's take a look at the financials and see whether it's actually worthwhile to potentially buy this one. It actually has a very low market cap right now, $139 million. It's a very small company, very small company. And a high short interest rate, 24%, potentially giving us an entry point for a short squeeze. Who knows? It's maybe something to look at. It also has low outstanding shares, which means a low float for trading, which could actually also, help the short squeeze movement upwards if that ever happens. Now, the company hasn't been diluting investors or actually buying back shares too much. It's more or less the same, a few million here and there. I wouldn't be too worried about it. But let's see what the company is doing in terms of its financials, which is the most important thing, obviously, and start with the income statement. Now, the very interesting thing in the last 12 months, they are enjoying massive growth in revenues, which is nice to see. And it's actually the best that they have ever done. So, this is their top year, which is always nice to see. However, they are losing money in terms of their operating income, and their net income here, as expected, would be in the minus. And even though they have really grown their revenues, they are still losing money and actually more money. And this is worrying. I mean, growing revenue so much and still losing more money, that's a little bit worrying. I mean, it could happen, of course, and it may be what they are aiming for. But these kinds of companies, especially used car companies, tend to have very low margins. So I'm a little bit worried that this is not going to change anytime soon. So the balance sheet of the company has total assets that are growing, but they are still pretty low. And total liabilities that are very similar to assets are still a little bit less though. So they do have more assets than liabilities. And a total equity of 116 million here. So the total equity is actually more less than the total liabilities here. So that's very interesting. Let me find it over here. So the total liability is 256 million here. All right. So the next thing we're gonna take a look at is the cash flow, and you will see here that the cash from operations is in the negative, as we would expect. The company is not making money, even though they are increasing their revenues massively in the last 12 months. As I mentioned, this is a little bit of a problem, and issuing a little bit of debt here and paying back some debt as well, kind of normal stuff here. But for the most part, they do have more debt than what they are repaying. So the free cash flow is also in the negative, similar to the net income, and also growing more negatively here. So it was actually minus 32, and then kept creeping higher debt here in terms of free cash flow. They're actually losing money, as you can see. Their multiples are obviously pretty low. I mean, because the price has been really beaten down, so the enterprise value is very low right now. And I'm just opening this tab because I want to examine the debt over here. Look at this debt. It's almost as much as the cash and short-term investments here. And yeah, this is quite some debt over here. Okay, the return on equity is very, very negative, massively negative here. Okay, that's also very bad. And total debt to equity, as we examined already, which is 66% here. So the company has a lot of debt when you compare it to their equity. So this is a company that could potentially even bankrupt. I mean, doesn't mean that it will happen, but they need to start posting some profit at some point soon, because they seem to be in a dire spot right now. And what I could see happening with this one is basically they either start selling more shares. The problem is that how many shares can they sell? I mean, right now their stock price is very low, so I don't know if it makes any sense for them to issue shares. So probably that's not going to happen. They may actually get more debt, which is likely. Or the other option, of course, which is not really an option, is that they have to start posting profit and actually keeping some profit as their free cash flow. And I'm not sure whether they can do that. Again, margins for this kind of company tend to be rather low here, and so I'm a little bit worried about this one. And still, even in the next 12 months, there's no projected PE here, which means that they are projecting that the company will keep losing money for the next 12 months as well. So the only good thing about this one that I see is that the price is very, very low. It's very cheap right now in terms of the price. However, the company is not posting profit, and so how much is it worth it? I don't know. You're taking a bet if you want to enter here, and so I'm telling it to for the subscriber who is who asked to make this video, and for all of those who are interested in this company. You could buy a little bit, but it's a bet, and you don't have anything to rely on here. It's gonna be that the company somehow reverts the situation and actually posts free cash flow that's positive and starts paying back debt and all that, or it could do worse and worse. I wouldn't be surprised. So this can happen, and remember, if this is $1.74 right now, it doesn't mean that you should buy because it's cheap. Because at some point the company could have a reverse split, let's say 10 to 1 to 10, and then all of a sudden the stock price is $11, and then starts dropping from 11 again and does the same thing. It's important to buy something because it's doing well, or you know that it's gonna be doing well in the future for some reason. So don't just rely on the price or how far down it has gone, because it can go down even more. So be careful about that. I hope you enjoyed the video, and hope you like this kind of analysis. There's not much we can say about the free cash flow. We cannot really do any projections for free cash flow in the future because everything is negative right now. But we did examine the financials, and we have a clear picture about the company really. So hope you enjoyed this one. If you did, please leave a like and subscribe. That helps a lot. And if you did like this video, you may want to take the time to take a look at this one that I made earlier, and it discusses Alibaba and how long it will take for the company's stock price to reach 1,000 if that happens. Thank you for watching. See you soon. Bye bye.